today I want to completely change how you think about credit scores. In fact, not only am I going to try to change your mind, I'm going to try to convince you to stop tracking your credit score, and you'll understand why in a minute. But I'm also going to explain to you why the credit score that you see is significantly different than the ones that the banks are using to approve you for credit, and I'm going to explain how credit bureaus are the original AI. Yes, that's right, the credit agencies, long before ChatGPT and Bard, were the ones that created behavioral predictive models, and they used it to determine whether or not you should get a credit card. But before I get into all the details, do me a favor. If you find this video useful at the end, click the subscribe button and hit the like button so more people like you can see it. And by the way, I do think you're going to find the information in this video quite useful because credit bureaus have changed. They are no longer just a record of the past. They are now a predictor of the future, which means the way you need to think about credit bureaus has changed substantially. I'm going to start by saying that this is not your typical credit score video. If you want to see one that explains exactly how credit bureaus work, I'm going to link to that at the end. This video is about modern credit bureaus and how you need to change your thinking with respect to your credit, because all of the advice from the past no longer applies in the future. And I know it might seem weird, but monitoring your credit score is actually hurting you. It's not helping you. So let's start by talking about the credit bureaus of the past versus those of today. And this actually explains why the credit scores that you get from those companies that give you your credit score for free in order to sell you stuff, and the credit scores that you get directly from the credit agency are significantly different than the ones that are being used by lenders to determine whether or not they should loan you money. And the reason for that is that credit bureaus have been developed over decades. These are algorithms that have been used and developed in order to predict your creditworthiness. And in the past, they were a record of your history that hopefully would be a predictor of your future. But banks and credit agencies obviously figured out that your past behavior isn't always an indicator of your future behavior. So as a result, those models evolved. And when you get your credit bureau from one of those credit score agencies that provides it for free in order to sell your information to companies that want to sell you credit cards, or when you get it directly from the credit agency itself, the reason why the score that you are seeing is different than the one that the banks are using is because they are selling you the old versions of the credit scores. The banks, on the other hand, are getting the new versions, which are the artificial intelligence behavioral models that are designed to predict whether or not you will default on a loan or go into bankruptcy long before you do. So these scores differ from the scores that you're getting in the way that they're predictive in nature, which means you have to adjust how you think about credit when it comes to these types of scores. In the past, if you missed a payment or you applied for a lot of credit or you had a high credit utilization rate, you had a low score. And for the most part, those things were pretty equal weighted. But now what credit bureaus are more interested in is what's happening right now and whether or not that is an indicator that you are going to default on your credit or perhaps even go into bankruptcy. And once you understand this, it becomes very clear what you should be doing with your credit. And what that means is that there's now more of an emphasis on your credit utilization. So in other words, how much money you have available to borrow versus how much you're actually using. And high utilization rates have a significant impact now on your credit score, especially if you go over the limits on your lines of credits and your credit cards. And this is because in a behavioral model, if you are at limit or above limit on a credit card, that is indicating that you have spent more money than you actually have, and as a result, you may be more likely to default. And if you go over limit and you combine that with something like a 30-day missed payment, well, that becomes a pretty clear indicator to the credit agencies and the algorithms that you are at risk of going into severe financial trouble. In fact, you may already be there. And in the same way, if at the same time you apply for more credit, that is again another indicator that you don't have enough money to pay your bills. So in the era of artificial intelligence and modern credit bureau algorithms, it's all about the signals that you're sending to the credit agency. And the more signals that you send that indicate that you might be in financial trouble, the worse your credit score is going to be. Then if that becomes combined with missed payments, well, your credit score will tank. And this is where credit hacking has become such a problem. Because the signals that are associated with credit hacking, so applying for multiple credit cards in order to get points in order to buy things, are the types of signals that indicate that somebody might be in financial trouble. Now, if you're utilizing $0 worth of credit and you're applying for things, this may not have as big of an impact. But if you're running your credit cards up to their limit every single month, it could have a substantial negative impact on your credit score. Does this make sense? So let me give you an example. Let's say you have a $10,000 credit card. In the bank or the credit agency's eyes, would you be more likely to default on that credit card if you had a $9,900 balance or if you had a $0 balance? The answer is obvious, right? And this is where the big difference between the credit bureaus of the past and today comes into play. Because in the past, credit gurus would have told you that you should be utilizing your credit so it looks like you're creditworthy. And as a result, people would run their credit cards up to $9,900 and then pay them off. And in the past, that was fine. But in today's world, the signal that sends is that the cash that you needed to buy that $9,900 worth of goods wasn't available to you at the beginning of the month, and therefore you may not be able to make your payments. Now, take this one step further, and let's say you borrowed $10,500, so you are now over limit. Well, the signal that sends to the credit agency is now you really don't have the money that you need in order to pay your bills. And while this may not be the case, that's definitely the signal that gets sent. Now, take it another step further. Let's say you go over limit and you miss a payment. Well, that clearly happens when somebody is out of money. And if that happens, your credit score will tank almost immediately. And the same can be true for if you are at or near limit on a whole bunch of your credit cards and you apply for more credit. Because again, you're sending a signal that you don't have enough money and you need to borrow more. So while missed payments and your past credit history still plays an important role, it's now significantly more important to send positive signals to the algorithm that you're creditworthy. And that means reducing your utilization rate as much as possible, while at the same time only applying for credit that you need and making sure that you never miss a payment. Now, let's say you need to improve your credit score. Well, there's some things that can only be fixed with time. If you miss a payment, probably going to take about 7 years for that to come off your credit bureau, so that's going to take time. Now, if in those 7 years you show that you are more creditworthy, it's going to help, but the fastest way that you can increase your credit score is to pay back as much of your loans as possible and keep those utilization rates low. So in other words, if you've got a $10,000 credit card and you can keep the utilization rate at close to zero or zero, that's far better than using it every month. In fact, in a modern credit era, if you can only use your credit cards just enough to keep them open, so once or twice a year, that is far better than trying to use them monthly in order to prove that you are creditworthy. You've already got the credit cards. If you can prove that you'll never miss a payment and that you don't really need them, you're way better off than if you were trying to prove that you can use them by running up a bill on them. The days of you have to use your credit card on a monthly basis in order to prove you're creditworthy are long since over. And doing things like making sure nothing ever goes to collections, and if they do, paying them off immediately helps a ton. Now, I know collections are usually about disputes, and while you may not agree with them, you don't want them to linger on your credit bureau for long. Pay them off, then go back and fight with the company about it after the fact. Don't let a company destroy your credit over principles. Because even if you are 100% in the right, a company can still destroy your credit by putting something into collections. So do your best to make sure it never gets there, and if it does, make sure you get it paid off as fast as possible. And on top of that, avoid credit hacking. Avoid the companies that give you free credit scores in order to sell you more credit. Because if they're giving you something for free, that means they are selling your information to somebody else. And while they may not be giving that information to them directly, they may be marketing to you in order to get you to apply, which is essentially the same thing. Applying for an extra credit card here or there probably isn't going to make a huge difference. However, that being said, if you aren't overutilizing your credit and a company that you have a credit card or a line of credit calls you and says, hey, we've auto-approved you for a limit increase without having to check your credit bureau or do any of that stuff, always accept the offer, but only if you are sure that you'll not borrow that money. Because as your credit limits increase, that creates a better utilization ratio, and that will help your credit as well. So stop tracking your credit on a daily, monthly basis and start paying more attention to your financial habits. It will have a far greater impact on your credit score, and ultimately, if you're focused on growing your money and making sure you spend less than what you make, you'll be far more successful than worrying about increasing your credit score by 10 or 20 points. The credit score is the lag indicator. Your habits are the lead indicator. What you do now is what affects the credit score. Focus on that which you can control, and your credit score will follow. It's that simple. And here's what you need to remember. Building your credit is a long-term game. It's not something that happens quickly. It's something that takes time. And if you're patient, you always pay your bills, and you don't spend more money than you have, you with complete certainty will have a better credit score. And if you want to see more details about how credit scores actually work, make sure you check out this video right here.